Hello, this is Brian Shannon from AlphaTrends.net. Today is Tuesday, the 25th of March, 2008. The market's closed, and the S&P 500 finished with another gain. It was right here, just at about the 135 level. You can see that 134.99 is the last print here right now, and it closed above that 50-day moving average once again, and that gets some news reporters excited. I heard one in particular this morning mention that that is a significant event. But what's more significant than that is the fact that this 50-day moving average is still declining, and what that means is these rallies typically will fail. And again, I don't mean that it means we're going to see lower lows, but it means that a lot of times you get people to look at a widely watched technical indicator like the 50-day moving average. You get a move above it like we saw here and here, and then it fails. And, you know, I'm not looking for a big failure here, but I think that at least a test of, let's take a look at this VWAP level from the January lows. I mean, at least a retest of this level down in here at 133.5. That seems very reasonable to me, if not a little bit deeper. So we've got, again, I want to point out the diminishing volume of this rally. The fact is the market continues to rally and prices are moving higher, and anyone who's sold short in the last couple days, except for, of course, you know, some good intraday entries, but for the most part, they're you know, not in a winning position. In fact, the 2-day VWAP is right around at this level at 134.83 or so, and that's where we found a little bit of support here late in the day today. For the 1-minute time frame, you can see that's also in about the same exact spot. When we look at the intraday time frame, what you want to look at in here is this 134.5 to 135 level. We did dip below that down towards the 134 level, and yesterday I was saying that you know, wouldn't be surprised to see even a retracement down towards the 38.2% retracement level of this recent rally. That brings it all the way, or actually I wasn't looking at this rally, but we will look at this one from the March lows, that is. That would bring it down to 132. If we took a look at the Fibonacci off this most recent leg, then that would bring it down to 133.5 or so. And that's, again, now we're starting to see that's where the rising 5-day moving average is found as well. So it wouldn't be all that damaging, but again, the diminished volume in here says that this market is going up because the sellers have pretty much given up, and they're for the short term, that is, there's just an absence of supply. So any buying that comes in pushes stock prices higher. And maybe it's the end of the quarter type movement here that we're seeing is pushing prices higher, and that may hold it up here for a little bit. But that's just a big warning sign. Again, only price pays. So when we look at the 30-minute time frame again, the you know, bullishly, we see that this prior level of resistance is holding as supported. You know, it breaks down slightly intraday here, but again, it's not the breaking of the trend line, but the subsequent action. And you know, we do see, though, a lower high in here today. So that's a slight reason for concern. The market has experienced quite a strong rally up here recently to a level where you would expect to find some selling at that 50-day moving average. We haven't seen it yet, but you have to be on the lookout for it, and breaking below, you know, back below today's lows could lead to a bigger sell-off. So still a lot of mixed pictures here. It's easy, again, to get excited about the fact that you know, this rally here of the last 3 days or 5 days or whatever has been X percentage, and we haven't seen that in how many years. But the point is here, you know, just focus on these shorter-term trends. We're seeing a lower high. We're seeing these moving averages cross. That represents indecision. So at the, you know, as the volume tapers off and we see indecision, the market will often go in the opposite direction. When in particular it captures, you know, people looking at this 50-day moving average and saying that's it, it's a buy. And again, it's the direction of the 50-day moving average that's more important. We still have the 10-day moving average below the 20, which is below the 50, and that 10-day moving average is starting to creep up. But that's only going to represent, you know, further confirmation of indecision when it does cross up to the 20-day moving average. So a lot of encouraging signs in here as far as, you know, the market absorbed all that negative Bear Stearns news as it made that lower low last week. The market rallied up, and now we've got some higher highs and higher lows on the short and intermediate term time frames, but you know, it doesn't mean the market is ready to turn higher. To me, I think that we've seen a correction price-wise. Now we might be just needing more time to digest this. wait for more news. People's confidence begins to increase as it stops going lower and that sort of thing. So again, it's a bottoming process. You can always point to a day and say, hey, that was the bottom, but it doesn't mean that it's not going to take a lot of time to see higher prices. So continue, I think, to just trade this market. And intermediate term, we've got a rising 5-day moving average, but we have a lower high. That's the first sign that kind of confirms the suspicious nature of this rally that we've been noting because of the diminished volume. The XLF. In here, what we're seeing is this market is also battling with the 50-day moving average on diminished volume. We've got this longer-term downtrend line in here. We've got this prior level of resistance that seems to maybe have some selling up in that area again. So we've got to just continue to be careful in here. So potential for resistance near 28. It was very encouraging today to see that this 26 to 26.20 level that I've been mentioning did hold, and that's a level that was important, back in February. So this, little area of support and resistance. It's not always an exact number, but more of an area of support and resistance. We do have these higher lows and higher highs in here, but late in the day today we saw that this lower high failed to hold, and this group is getting a lot of headlines. It's had a heck of a rally here, 5 points, or 20% almost, 18% from those lows. So a further pullback wouldn't be an unhealthy thing for this market, but if it breaks below this 26 level, this becomes, further strength. The importance of it brings on added significance the more times it acts as either support or resistance, and then supporting and breaking it once again is just going to kind of throw a lot of people off guard. And it wouldn't really come as a surprise because this market seems to probably want to need more of a time correction, similar to what we're seeing in the semiconductors. A lot of people were getting excited about those, but they, here as they rallied above the 50-day moving average, the declining 50-day moving average for 2 days over in here, then they failed, and now it's back to, that bottoming process. This is a lot more bullish looking because we've got a 10-day moving average above the 20, above the 50 in the semiconductors, but we've still got a lot of bigger, longer term problems with this market, and it's going to take time to heal them. As far as the Russell 2000 goes, this market is rallied above this 50-day moving average, closed with a nice gain in here today of about 0.5%. Once again, though, look at the volume in here. It shows that the buyer's conviction isn't there, that they're chasing prices higher and not finding that source of supply. But eventually, as all markets do, the job of the market is to facilitate trade, and the market will continue to expand in price until it meets that source of supply, which slows it down or turns it all at once. And it might come through distribution, or it might come in a sudden news-driven event. There's still a lot of headline risk in this market. We've still got a lot of earnings to be reported. We're at the beginning of the earnings season. That's going to really start to pick up the next 2-3 weeks. And there's going to be a lot of shocks to individual companies, so you've got to be aware of those individual trends as well. The average price for this market since the January lows, we're comfortably above that, right near about that 68.75 level, and that adds, that level has added further significance because it was tested so many times as support and then had a hard time getting through as resistance as well. So any pullback, we're going to, look for this 68.5 to 69 level to hopefully hold this market up, and that will continue to, maybe put this 72, 72.5 level into potential play on the upside. It could go either way here. The path of least resistance on the longer term time frames is still lower. So when in doubt, always cast an eye of suspicion on it if the longer term time frame is still sending negative signs like it is here. If the longer term was higher and we had this indecision, then we would expect that the most likely course of action would be the market would continue higher. But that's not the case. We have mixed signals from multiple time frames. We've got a lot of headline risk in there, and it just still is prudent to be very careful in this environment. The Qs yesterday, we saw a real large rally in here as it broke the this downtrend line evidenced on the daily time frame. Got above that declining 50-day moving average as well, and same thing here. Really light volume the last 3 days as compared to this. And this moving average on the volume, by the way, is a 20-day moving average of volume, and I don't look at that as buy and sell signals, just to kind of give me an eyeball of what's going on in here. And the lighter volume as the market rallies, still it's going to pay the same whether you make $10,000, $20,000 on light volume or heavy volume. It's going to hurt just as bad if you lose on light volume or heavy volume. Price is the only thing it pays, but this gives us a reason to be suspicious of this rally. So it means keep your stops tight, look for evidence of weakening on the shorter term time frames, and we don't see any of that evidence. In fact, just the contrary. When we look at the 30-minute time frame, we were looking at this 43.50 area, 43.60. That was an area that I thought might come down and test that level. I wanted to see it come down, test that level, maybe meet that 5-day moving average and then rally. But this market rallied through the 43.50 and 44.50, which was an even more important level of resistance, I thought, because the subsequent decline from there was so strong. But now that it's holding above 44.50, we've got one potentially solid level of support underneath us, and then another one at 43.50. So, and we've got, even in here, as I was pointing, I'll go back to the 10-minute time frame, we've still got, in the Qs, we've got this pattern of higher highs and higher lows. I think that breaking below 44.25 or so, then I think we come back down and maybe test the 43.50 level. But for now, the path of least resistance is still clearly higher. The market was above the daily VWAP for most of the day. In the 2-minute time frame, you saw, 2 days, we saw that the average price here over the last 2 days is what acted as support in here today. So mixed picture across multiple time frames. Overall, though, this market is acting strong. It's got a lot of people's attention that it's above the 50-day moving average. A lot of times that turns out to be a trap when the 50-day moving average is declining. That gives us reason for suspicion, as does the diminished volume of this rally.